Hello learners, welcome to this another lesson of financial management course. The topic of the today's lesson is risk and return. As you know, whenever we make an investment or an investor makes an investment, he is expecting certain return. Return may be either in the form of regular income or capital appreciation. But the moment we make an investment, every investment is subject to risk. Now let us understand what are the different types of return expected by an investor and how to calculate that. And then we will learn about what is the meaning of risk and how the risk is interpreted and calculated. So in this video, we learn about return part only, and next video is devoted to risk part. Now meaning of return. Return means whatever is expected by an investor from his investment. His expectation may be either in the form of regular income like interest or dividend. As you know, if you create a FDR, that is fixed deposit receipt, in a bank or post office, you are expecting to earn the interest. Similarly, if one makes an investment in the debentures, he is expecting to get regular interest at the interval of every year or every 6 months till the maturity of the debenture. Whereas, if someone makes an investment in the equity shares or preference shares, he is expecting to get the dividend. So that is the part of regular income. Apart from regular income, the investors do expect the capital appreciation. That means appreciation in the invested value. As you see, many people buy equity shares of the company listed in the stock market or apply in the initial public offering or IPO or rights issue. The main aim in that case is he is expecting capital appreciation. That means to say, if he buys a share at rupees 100 per share today, he is expecting in the near future or in the distant future, it might rise to 150, 200 and something like that. So that is the another part of return, capital appreciation. Now, return will totally depend upon market trends, investment revenue, and the level of risk assumed by the investor. Now, whenever we say an investor is expecting the return, there are different premises for expecting the return. It means to say, if you have to assign that how much you should expect from a particular investment, that particular expectation is dependent upon three parts. Number one, reward from waiting. Why I will say waiting? Because if suppose you have rupees 1 lakh today, you are investing in either bank fixed deposit, insurance policy, equity shares or debentures, definitely you are postponing the current consumption of your money. You are postponing the current utility of the money. Utility will come to you when you get back the money from the investment. That's what you need some reward for waiting. That is compensation for time, it is known as, or time premium. Then you need some reward for the risk. Depending upon the level of risk, you will be expecting additional return from your investment. If risk is high, you will expect higher return. If risk is low, you will expect low return. Because generally we understand that there are certain risk-free avenues, government bonds, deposit in the bank and something like that. From that, we have almost 0% or negligible quantum of risk-free risk compensation. That means from a risk-free avenue, we are satisfied with reward for waiting only. Then the third component comes reward for compensation against loss of purchasing power. Now, if you know, loss of purchasing power takes through inflation. As soon as with the passage of time, purchasing power of the money decreases, you need extra compensation from your investment. It means to say the basic premises or deciding how much we must expect from an investment is completely dependent upon these three parameters. Now you might be saying, practically I don't do like that. But yes, in the back of your mind, calculation is going like that. Let me explain you. If your reward for waiting is 10% and your risk compensation expectation is 3% and inflation is 4%, that means you expect that year on year prices will increase by 4% for the different commodities or the products which you wish to buy from your money. It means from your investment in this case, you are expecting 17% return year on year. So that calculation always goes in the back of your mind. Now, let me give you one more example. If suppose someone comes to you, he says make the fixed deposit in their bank or in their scheme, they will give you only 3% return. Now, you might say no to him. Reason being, you will say because inflation is already 4%. Now, that person is giving you 3% return. It means to say, if you deposit rupees 100 today, after 1 year, that person will give you back 103. Whereas, whatever you will be buying after 1 year from the same 100 rupees, that will cost you 104. So you will say, why should you wait for 1 year? Let me consume it right now, because today's purchasing value of that particular product is 100, and after 1 year that will cost you 104, whereas investment is going to give you only 103. That means to say one single parameter is sufficient to define if return from an investment is less than the inflation, definitely you will not invest in that avenue. So this is the way people decide how much to expect from a particular investment. Then question comes, how to calculate the yield? Yield is the internal rate of return from the investment avenue. It is the function of multiple factors like risk, time horizon, market trends, and many more. Longer the time horizon, generally higher will be the return, but in short term horizon, less will be the return. Similarly, we say higher the risk, higher the return. So those are the common fundamentals, but completely return will depend upon the avenue selected by you. Now, when we say yield is always return in percentage terms. If I say you have invested 1 lakh rupees today, after 1 year, it becomes 1 lakh 5,000. That is 1.05 lakhs. So in percentage, you have earned 5% return. So absolute amount we don't count for the yield. We always count yield in terms of percentage. That is the way yield is defined, that how much percentage return you are getting it. Now, this yield calculation has got two type of concepts: holding period yield and yield till maturity. Now, generally when we say holding period yield, we are talking about investment horizon up till 1 year. It means to say, if you are investing at 0 time and after 1 year you want to get back your money, or maturity of the investment is after 1 year, then two type of returns are expected by you: regular income and the capital appreciation. So regular income is denoted as R1, and as explained earlier, regular income may be in the form of interest or dividend. Whereas capital appreciation is simply P1 minus P0. Now what is P1? P1 is the maturity value or the sales price of your investment at the end of year 1 or at the end of period 1. Whereas P0 is the purchase price. So in that way, we can calculate the difference between P1 and P0 as the capital gain. So holding period return will comprise of regular income plus capital gain as a function of the invested amount will give you return in percentage. Now let me remind you one thing at this point of time. Sometimes holding period return or yield may be negative. Negative means you have lost your capital, or sometimes holding period yield may be less than the expected return as you expected at the time of investment. And that particular part, that particular fluctuation in the expected return is called as risks. So now we can define the risk also. Risk means probability of having less returns as compared to the expectation, or chances of getting negative return from your investment. So that is the way holding period yield or return will comprise of regular income, either in the form of interest or dividend, and capital gain, that is the difference between the maturity value or sales price of your investment and the purchase price. Now let us see how to calculate these returns, that is holding period return. If an investor purchases shares of a company at a price of 320 per share, which has a face value of rupees 10 per share, it is expected that the company will declare a dividend of 65%. Now let me tell you one more fundamental at this point of time. Dividend percentage, in this case which is 65%, is always the function of face value. It means at the end of the year, person will get rupees 6.5 as dividend. So don't get confused that you will get a dividend equal to 65% of 320. Company will always give the dividend subject to the face value. So if company says dividend percentage is 65%, it means whatever is the face value, in this case it is 10 rupees per share. So company will give you 6.5 per share as dividend at the end of the year. Dividend payment is again dependent upon the profit of the company. So in this case, the investor is expecting 6.5 per share as dividend at the end of 1 year. And he is expecting that after 1 year, he will be able to sell his shares at 390 rupees per share. So now we can calculate what are the parameters with us. We have regular income 6.5 per share. All amounts are in rupees. His P0, the purchase price is 320. And the sales price, he is expecting to sell the share at 390 after 1 year. So gap between this 390 and 320 is the capital gain, 70 rupees. It means now if I calculate holding period yield, his regular income is 6.5, his capital gain is 70 on an investment of 320. So if we convert that into percentage, that means 76.5 divided by 320 multiplied by 100. So it will come out to be somewhere 22 or 23%. Let us check it out, how much it turns out to be. 23.91%. That means he earns 23.91% return in a year on his investment. So that is the way holding period return is calculated. And you can see we have a formula like that also. Explanation of the formula is also handy with you on the screen. So generally, holding period yield is calculated for 1 year holding period. Now question comes, if your holding period, so this is the solution also you can see. Now in the question, what I had calculated right now, this was the before tax return. And as you know, everyone generally is subject to the tax payment. So in this question we are given, if tax rate applicable for the investor is 30%, then how much will be the after tax return? So always calculate holding period return in two terms. One will be before tax, which I have calculated 23.91%. It is before tax, that is pre-tax return. Now we can convert the same pre-tax return into post-tax return. So yield after tax, as you can see, we have pre-tax return multiplied with 1 minus tax rate. 30% tax rate will be plugged in as 0.30. So effectively, after paying the tax on his income, that is dividend which he receives 6.5 and the capital appreciation 70. If he is paying 30% tax, so his after tax return is 16.73%. Now you might say he is paying tax only 15%. Then we can convert that return into after tax by using same 15% tax rate. So it will be 23.10 multiplied with 1 minus 0.15. So what we get? 23.91 multiplied with 0.85. So let us convert that into after tax return with 15% tax rate. So it becomes 20.32% return. And if he is paying zero tax, then there's no problem. He gets same 23.91% as the holding period after tax return. So this is the way holding period yield can be calculated. Now we will go calculation of the yield when transaction cost is involved. As you might be knowing that whenever we buy or sell the shares, definitely some transaction cost like brokerage, service tax, GST and all that is there. And turnover tax and transaction tax of SEBI is there. So effectively we have to mold the formula. Now only thing is that in this case M is the maturity amount. Here maturity amount will be after deducting the transaction cost. Similarly, purchase price P will be after adding the transaction cost. It means effective P in your case will be there, purchase price of the shares plus transaction cost TC. Whereas in maturity, you are getting back your money. So if you sell your shares through a broker, he will charge you the brokerage, SEBI transaction tax and turnover tax and all that. So effective M in the formula will be sales price minus transaction cost. So that alteration you have to do in the values, rest of the things will not alter, or calculation mechanism will remain the same. So always use effective M after transaction cost and effective P after transaction cost. And that's the way we can include the concept of transaction cost in the holding period yield. We can take the same example. Example is the same. In this case now, 2.5% is the transaction cost on purchase as well as on the same sales. Now it may be 1%, 0.5%, nowadays 5 paisa brokerage is also there. That is something different. I have to explain you the calculation mechanism that depends upon how much transaction cost comes. So now what we can do? In this case, 2.5% is the transaction cost. So his R1 is the same, 6.5. But now what will be P? 320 plus 2.5% of the 320 is the transaction cost. So his transaction cost is rupees 8 per share. So his effective purchase price is 328. Then M, he is going to get 390, but now he has to pay 2.5% on this to his broker, that is 9.75. So when he pays 9.75, he is left out with 380.25. So precisely for calculating holding period yield, his amounts will be like this. So his capital gain is now 380.25 minus 328 divided by 328, and definitely when we multiply we will get answer in percentage. So 380.25 minus 328, so capital gain is now only 52.25. So 6.5 plus 52.25 divided by 328, you will get your answer like this, 17.91% before tax. Now subject to the tax regime, he can pay the tax on his income, and accordingly things will move and we will calculate after tax yield. I hope concept is pretty simple and you are getting it. So that was the solution. You can see again I have captured the solution in word format also. So 17.91, it means our calculation was correct. Now that was the holding period yield. As I depicted earlier, whenever you hold the investment only for 1 year, then holding period yield formula is there. But the moment you hold the investment for a period more than 1 year, we will end up calculating yield till maturity, popularly known as YTM. Now yield till maturity is calculated whenever an investment is held up to a complete maturity period or for a period more than 1 year. And there is a handy formula for YTM. It is pretty simple. And this is the approximation formula which we use generally. So always remember, this formula can be used very comfortably for calculating return in the case of debentures if you have purchased. Generally this formula is calculated for fixed income securities like debentures or FDR or something like that. In this case, R1, that is return per year in rupee form, like interest per year or dividend per year. Maturity value is how much you get at the end of the tenure of your investment, 2 year, 3 year or 5 year. And N is the number of years for which you hold the investment. Remember, this 2 is constant in the formula. This is numerical 2, so don't disturb it. So all the explanations are given. Now let us see how the calculation is done. Now a company issues debentures. So as I told you earlier, usually this particular YTM concept is used for debentures. Now a company issues debentures of face value rupees 100 each at a premium of 3%. Now let me remind you at this point of time, interest calculation, dividend calculation and premium, if any, all these are the function of face value. So always remember, in the quantitative questions or numerical in your examination, if we are given company issues debentures of so and so at 3% premium, it means premium will be calculated on the face value. Similarly, company will pay 9% interest in this case, So interest 9% will be calculated on face value 100. So always remember, calculation of dividend, interest and the premium or discount is subject to the face value or is a function of face value. So in this case, 100 rupees face value debenture issued at 103. So the issue price by the company will be 103. So if you happen to buy from the company, you have to pay 103 for every one debenture of face value 100. Company will pay you 9% interest per annum and have a provision for redemption at a premium of 10% after 7 years. It means maturity value will be 100 plus 10, because 10% premium. So company will give you back 110. It means now you can see, you pay 103 to company right now, and at the end of 7th year company pays you 110. So over a period of 7 years you get a capital gain of rupees 7. Apart from that, company will pay you interest 9%. So 9% of 100 is 9. So I have put all the values in rupees terms. So every year from the end of first year till the end of 7th year, you will get a regular income in the form of interest, rupees 9 per debenture. Now let us calculate it. So your YTM, as the formula was there, regular income is 9, maturity value is 110, your purchase price is 103, this is divided by N, which is 7, divided by the average of M and P, and we can get the answer. So we get it 9 plus 7 over 7. So first solve this part. 110 minus 103, you get 7, divided by 7, which is the maturity period. So by chance this 7 and that 7 but are same, but in writing 7 is same but both are different. This 7 is the N. So if suppose maturity of this debenture is 5 years, so we'll use 5 in that case. So don't forget that this is N. Now we have to divide it by the average of these two, that is 110 plus 103. So we get 115, I hope. Let me check, not 115, it will be 111.5 it will be. So it will be 1110 plus 103 divided by 2. So it is 106.5. So let us correct it. So 106.5 times 100. So effectively we get 10 divided by 106.5 multiplied by 100. So 10 upon 106.5 times 100, you get 9.39%. So your before tax annual return is 9.39%. It means if you buy these debentures from the company, hold it till 7 years and claim the maturity amount as well as interest year on year, definitely your annual return is 9.39% over the period of 7 years holding period. So this is the way YTM is calculated, and that is where the solution is also there in front of you. So that is the way, dear learners, we have learnt about two basic concepts of holding period yield. Holding period yield we calculated whenever your investment horizon is up till 1 year or less than 1 year, or YTM, which is calculated when you hold the investment for the complete horizon of the investment or maturity period of the investment, or for a period longer than 1 year. So always remember, this is the way we will be calculating returns. Now, I'll tell you one more small concept. If you go back to this particular part in which we had the holding period yield, let us say your holding period yield is 10% over 1 year, then there is no problem. We say yearly return is 10%. On the other hand, if suppose your holding period yield is 6% only by holding the investment for half year, then you can convert that 6% into yearly return. So one rough approximation is 6 multiplied by 2, 12%. So few people do it like this also. Now in this case, one more mechanism is there. If suppose your half yearly return is 6% and you want to convert that into yearly return, you can use this formula also. 1.06 raised to the power of 2 minus 1. 1.06 raised to the power of 2 minus 1. So you get it 0.1236. That is 12.36% return over a year. Now you might be surprised. when you multiplied 6 by 2, it was only 12%. But when I do it like this, 1 plus half yearly return raised to the power of 2 minus 1, it gets me 12.36%. My dear learners, you get the mechanism of compounding, because when we use this formula, 1 plus r raised to the power of m minus 1, definitely we are referring to the power of compounding, because whatever return you get in first 6 months, you will be investing the principal amount as well as the 6 rupees return on that one. So at the end of next 6 months, your return will be higher. So your return turns out to be 12.36%. So that is the mechanism of compounding. So R is the half yearly return and M is the number of compounding periods in a year. So you get effective annual rate 12.36%. Suppose in 3 months period, you get a return of 2%. So your quarterly return is 2%. You are interested to convert that quarterly return into annualized return. So do it like this. The same mechanism, 1 plus R raised to the power of M minus 1. So in this case, 1.02. And how many quarters are there in a year? 4 quarters and minus 1. So let us solve it out. 1.02 raised to the power of 4 minus 1, you get 0.0824. That means 8.24%. So 2% quarterly return gets converted into effective annual return 8.24%. So that means what is there? Effective annual return is equal to 1 plus periodic return PR raised to the power of M minus 1. You will get answer in fraction. So in this case, EAR stands for effective annual return. PR stands for periodic return. That means quarterly return or half yearly return. And M is number of compoundings in a year. So that is the way we do it. So this is simple case how we can convert periodic return into effective annual return. So this is all about this particular video. Keep on learning because learning is enriching. Thank you. Thanks a lot.